Dividend investors, bonjour, this is Mike Yeru, founder of Dividend Stocks and passionate investor. Welcome to this fourth video on my best and favorite utility stocks. So we already covered what utilities are good in your portfolio, the best renewable energy stocks, and the best Canadian ones. If you haven't seen those, make sure to subscribe to my channel and go back to those after watching this one. Today we're talking about my top 3 favorite US utilities plus one analysis request from YouTube subscribers. So 4 companies that we're going to look at today. Let's start with my first one, American Water Works, ticker AWK. Low dividend yield, 1.5%. You're going to tell me, Mike, it's not going to cut it to pay my bills. I get it. However, it is recession proof. They're providing water, and no matter what's going to happen in the economy, we all need that, right? Successfully increased their dividend since 2009. So we're talking about over a decade of dividend growth over there. So even though the yield is very low, stock price has jumped, there's a strong dividend growth there, and the business model is quite interesting. In fact, we're talking about regulated utilities. This means that whenever they invest money, they just go back to the regulator, ask for increasing their rates, and it's usually approved. 93% is distributing water to their customers, and then 7% of their business is wastewater. So we can think of just, what is most important in life is to get water in our body, and this is exactly what they're providing. They are well diversified across the states, mostly in eastern and center of the US, and they also happen to be in California and Hawaii. So maybe they're holding their shareholders meeting over there. It's such a great place, but in the meantime, they're pretty spread across several states, which gives a good diversification in terms of income. In terms of growth, we are obviously talking about the water pipes that are getting old, that they need maintenance, and this is where the most of their budget is going, and this is most of their growth will be coming from. So you can see that 5 to 7% of their earnings growth is expected to come from their capex, so their capital expenditure. We'll see that in the moment where they're going to put all that money. They will also expect to do a few acquisitions here and there, so for 1 or 2% of their earnings per share. And the management expect to grow their earnings per share by 7 to 10% for the next 4 years, which is kind of interesting if you are an investor and you're worried about the market, you don't know what's going to happen with the pandemic. Well, there you go. You have a safe shot with AWK. One thing that I really like about is the fact that they evolve in like one of the most essential business, but it's also a highly fragmented business. As you can see here on this chart, you have the difference between water utilities, electric utilities, and natural gas utilities, and you can see that there's a lot of dots on the first graph. This means that there's plenty of water utilities ready to be bought and acquired by AWK, and this is why they expect to grow their earnings by at least 1 or 2% per year in the upcoming years. Making new acquisition, it's great for those businesses that are a little bit bigger, like AWK. They benefit from economies of scale. It's easier for them to get financing and therefore acquire new businesses this way. The main growth vector, as I mentioned before, was their capex. So basically the way it works with regulated utilities is they go see the regulator and say, hey, you know what, we're going to spend a lot of money on our infrastructure and to make sure that people drink good water and there's no leaks and stuff like that, and God knows that this is something that we need. So therefore regulators will say, okay, so you spent like $9 billion in the upcoming years, we're going to allow an increased rate of this much, and then you're going to make more profit out of it. So what you see here is most of the money will come for infrastructure renewal and system expansion. So those are like the two interesting places. You have water quality, obviously, but most of the thing is just to make sure that people get water and that the water is for good quality. The last growth vector that is very interesting for AWK is that they develop an expertise for military bases. What I like about those is they're very hard to get, but they show super long-term contract. We're talking about more than 30 years contract. It gives AWK consistent cash flow. It's very easy to predict, and this is what we like in general for utilities, is that it's a stable business, predictable cash flow, and military service group is just perfect fitting for this kind of utility. This obviously reflects in their dividend growth. I mentioned that before. The yield is super low, but when you look at the growth, it's amazing. And actually, the stock price is also a little bit amazingly overpriced, if you would say it that way. I don't think it's really overpriced. The stock had a great run, but the thing is, you have to pay for quality, you have to pay for stability, and this is exactly what you get with a company like that, especially with a target payout ratio of 50 to 60% of earnings. This leaves plenty of room for future dividend increase, and it wouldn't hurt your portfolio if you had a few low-yielding stocks with high growth perspective like AWK. It could be something that is very good for your portfolio turn going the long run. Finally, in terms of debts, well, you all know utilities spend a lot of billions of dollars in their new projects, and American Water Works does exactly that. We're expecting to spend a little bit over $9 billion in the next 4 years. Most of it will come from debt, where we're talking about 60% of that money will come from debt. However, they can afford it because they have very strong credit rating compared to their to other utilities. It's fairly stable, and their debt maturity profile is well diversified across several years. I bet they wish they had a little bit more in 2020 to enjoy lower interest rate for renewal. But I mean, this is the life. That is always very important to look at how debt evolve quarter after quarter. Never take your eyes off that part of the balance sheet for utilities, because it's fun to spend a lot of money and to get granted better rates by regulators, but at one point or another, this debt has to go down. So just be careful with that. But overall, American Water Works, very great in investing your opportunities for stability over the long term. Water is not going to get away anytime soon, and if you're worried about what's happening with the market, well, this is one of the places where you can expect your money not to drop by 40% in the next market crash, most of it because it is a stable business. Now moving on to my second best utilities for the US, NextEra and NextEra Energy and NextEra Energy Partner. Obviously, you have two tickers here. You have NEE, which offer a low yield, like close to 2%, and then NEP, which is NextEra Partner. That's a yield co, so basically this is not for growth, it's more for income, and we're talking about a yield that is getting close to 4%. NextEra Energy, I'm not going to dive into NextEra Energy Partner too much today, but it's pretty much part of the company. So basically, their goal is to just put back the money in and to generate some high yield, and then NextEra Energy will manage other companies at the same time. So we're going to talk about NEE today. Dividend growth since 1995. It has been a major player in renewable energy. We're talking about a company that has now a market capitalization bigger than ExxonMobil. It was not even part of the top 10 20 years ago, and now it's the largest utility company in terms of market capitalization. 55 GW watt in operation, so huge business over there. You have Florida PL, you have Gulf Power, NextEra Resources, so pretty much everything around engineering, constructions, the supply chain, wind, solar energy, some nuclear over there in the mix. Well diversified across many states at the same time, and well diversified in terms of different type of energy. You can see NextEra is the energy world leader in clean energy infrastructure. And the business has been riding on this huge trend for the past decade at least. They obviously benefited from generous subsidies from government in order to build their wind and solar farm, which was pretty much a good timing for them. And at this time now in 2020, they are very involved into wind energy. 2/3 of their business is around wind, a little bit of solar, nuclear, and then natural gas, and small portion of oil. We're talking 3%. They're pretty much active across all the United States and several states. So this provides NextEra also a good diversification in terms of source of energy and in terms of geographic as well. So pretty much everything is to like a NextEra at this point. They obviously surf on this huge trend of clean energy, as I mentioned before. So we're talking about battery storage, solar farm, wind farm, hydrogen, gas infrastructure, name it. They are pretty much everywhere where there's clean energy. And this is what I think why the market likes them so much is they're big and they're kind of like becoming the next ExxonMobil, but not for oil and gas, but for clean energy. And this is what the market is looking for, is the market leader in something that will be trending for several decades to come. This is also one of the reasons why I didn't put it in my best renewable energy stock video 2 weeks ago. It's because I wanted to be part of the top US stocks. This growth reflects on earnings per share since 2018 up to 2023. Expected earnings is supposed to be between 6 and 8%. So quite stable, very easy to predict. And once again, very pleasing for an investor to look at that, especially right now because of the recession and so on. When you have management telling us we're going to grow our earnings like high single digit year after year for the next 2, 3, 4, 5 years, I kind of like that, and I'm pretty sure you do too. So as many utilities, they have a huge capex plan, and the bulk of their investment is going toward Florida FPL. As you can see on this graph, there's good diversification among various sources of energy and transformation and distribution. But we're talking about $23 to $25 billion between 2019 and 2022. That is a lot of money, and they want to put everything in Florida. We have seen that in the past. Florida is one of like the favorite states for many utilities that are doing well. It's a growing state, flourishing states, and this is why there's a lot of utilities that wants to have their piece of the cake. NextEra is very well positioned in this one, and they're going to increase their market shares this way and obviously increase their earnings as well. Small note on NextEra Energy partner portfolio. As you can see, very well spread across the United States at the same time. We're talking about a lot of wind, some solar as well. So 5,300 megawatt generated from renewable sources. Strong cash flow over there. You don't have to worry about your dividend. It keeps increasing all the time. That's what I like about those kind of companies, that they're still riding this trend and it's still growing. I think there's a lot of room for more renewable energy in the States. So you don't have to worry about what's going to happen in the next few years. I think that they can ride this kind of growth for the next 5, maybe 10 years, still going. There's definitely an interest in reducing coal and nuclear and oil and gas energy, and they're moving towards wind and solar. NextEra will definitely jump on this opportunity. It also reflects, obviously, for dividend per share. We're talking about a huge growth, almost double digit between 2004 and 2019. As I mentioned earlier, they have the cash flow. They are heavily investing year after year to ensure earnings to grow. So when you have earnings growing by 8% or so, it's easy to increase their dividend by almost pretty much the same amount. I don't expect that they're going to keep up with this such generous rate forever, but in the same time, we're talking again about low yield, high growth dividend stocks. Those are my favorite. NextEra is definitely part of the loot, and I think that you can expect several high single-digit dividend increase in the coming years. Finally, when we look at their credit profile, well, once again, They also obviously borrow a lot of money to grow, but they maintain very strong credit ratings among Standard & Poor's, Moody's, and Fitch. Then again, follow this part very carefully. Look at how they cover their interest and so on. So you have the ratio here. So debt on FFO and FFO on interest. We're talking about pretty much very solid coverage here. Good credit rating, well-balanced portfolio. I like the fact that they invest so much right now as it is trending, as the government wants that, and they're willing to grant subsidies and so on. And there's an appetite on the market for this kind of bonds and financing. While it all looks pink and rosy and with some unicorns, I have to put a small asterisk about NextEra Energy. It is on a huge trend right now, but at one point in time, debt has to be under control, and also the appetite for this type of loans may dry out at one point or in time. The government has printed a lot of money this year for the pandemic. At one point, they might say, you know what, we're gonna cut on those grants and on those projects. I'm not too sure I want to spend that much money anymore, not because I don't want to, but because I don't have it in my pocket. So maybe growth vectors going over the next 5 years will slow down a little bit. Nevertheless, it's a very strong utility. If you're looking for more yield, go for NextEra Partner, that's the yield co. If not, if you want to have a good part of dividend growth and stock appreciation, go for NextEra Energy NEE. So here's another utility that will complete my top 3. Probably one of my favorite, because Xcel Energy is a great success story about a utility company that is moving away from coal towards renewable energy. The yield's a little bit better. We're talking about roughly 2.5%. Dividend growth since 2004, paid quarterly, very healthy business, well diversified with a lot of electric distribution and transmission, which I like because it brings stable business. Their goal is to keep increasing those part, more renewables and less coal, so which is kind of cool. They're right now having 8% of their business in coal, 6% in nuclear, so this is expected to drop to 4 and 3 respectively. While renewable electric transmission and distribution should be the big part of everything. And they also have some natural gas distribution over there. So I like the fact that they have multiple streams of income and they're well diversified and obviously moving away from coal and nuclear. When you look at the business, we're talking about 3.7 million clients for electric customers, 2.1 billion for natural gas. A little bit in Texas, a little bit in northern states. So we have a good balance here. And what I like about that is in regards to their growth plan, well, they are well situated geographically for 2 things. So on the up north, they have strong wind. So they're going to build their wind farms over there. And up in south, they have lots of solar energy potential over there. So for the solar farm. So you can see how they will deploy their money in a smart way in according to maximize all geographic position and where they are at. I love this business model for that reason, because it's great balance between wind and solar at the same time. Recently, they have used $3.6 billion to fund 8 wind farms. You can see how they are putting a lot of money towards renewable energy, and this is not going to stop. Their plan is to move even forward. You look at their robust capital forecasts between 2021 and 2025. We're talking about $24 billion. Lots of it will go into electric distribution and transmission, and then some generation and natural gas. The base now is, the idea here is to also increase their budget towards renewable energy, so from 2% to 8%, to give something a little bit more into wind farms and solar. Such solid capex, with such a great capex structure and lots of planning, there comes a lot of dividend growth at the same time. What you see here is the progression of the company going from a $3.5 0.4 dividend increase per year on average between 2005 and 2013, and now moving up to 6% on average over the past 5-6 years. You can see that's a great trend. It's no secret, the stock price has also increased accordingly. And what I like is going forward, the company also expect to have some strong dividend growth here. So we're talking about earnings per share should grow between 5 to 7%, and then the dividend is expected to follow the same trend. The company is maintaining a healthy payout ratio around 60 to 70%. That's a great target. This leaves enough room to manage their cash flow between their projects, getting good credit and good funding for their for capex, and also rewarding shareholders with dividend increase. Speaking of which, when you look at how they will finance their new projects and their 22 billion plan through 2025, a lot of it is coming from cash from operation, which I always like because it's always better to use your own cash than to use debt. They will obviously use a little bit of debt to enjoy some leveraging and make it profitable even a little bit better. But at one point in time, as I mentioned earlier, for utilities, that has to be checked. And when you look at a company that is able to finance most of its projects with its own cash flow, it's always a safer bet, even though debt is cheap and it's easy to get right now. Think long term. Xcel Energy has a very strong credit profile over there. Speaking of which, credit rating pretty strong, grade forward. I like when the company is telling us what they expect for the next 5 years, how they're going to manage. But you can see here is one thing, it's stability. And this is what I like the most about Xcel Energy. They know what they're doing, they know where they're going, they have a solid plan, and they actually follow it all the time. This is no secret that the stock is going well, but I think that if you're looking for a safe place for your investment with a decent dividend with some dividend growth, Xcel Energy could be a very good candidate. All right, so last but not the least, or maybe the least, or I don't know, it's an intriguing pick actually. It's coming from one of our YouTube subscribers. He was asking about Vistra Energy, and it kind of piqued my interest. I'm not too sure I would put that in a top utility stocks, but you know what? I feel kind of like there's something there, a little bit more risk, but the yield is good. The company has started to increase their dividend this year, and they show some great promises about that in the upcoming 2 years, which kind of piqued my interest a little bit more, and I wanted to go deeper on this one. First, know that Vistra Energy is actually it has risen from its ashes. It has declared bankruptcy. It was part of a bankruptcy back in 2016, and now it's all looking clean and nice with a brand new balance sheet. But there's like a few things I'm not too sure about, and let's dive into it. First, when you go on their website, what is interesting is that they're all telling you about we're moving towards solar panel and solar energy, and we want to decrease our carbon emission, and we want to be clean and so on. And I'm like, oh yeah, that's cool. That's the kind of trendy discussion that management has for many utilities. So I kind of like that. And then I went a little bit deeper to see what's exactly Vistra Energy. And this is where I was like, so we're talking about a lot of gas, a lot of coal, a lot of nuclear, and a tiny bit of solar energy. And I thought, wow, it's kind of funny because on their website at first I had the impression that they were moving like very fast, but it's actually going to take several years. So they have this what they call the Vistra vision. It looks like like some kind of like Atari game or something like that, but the Vistra vision is all about moving away from coal and nuclear energy to move towards renewable, mostly solar. It's a 20-year plan, so here you have the first 10 years, and then eventually by 2040 they want to be completely clean. But like 20 years in the future, it seems a little bit like they're just talking about unicorns. I would like to see something a little bit more precise about what's gonna come up for the next 5 years, which I kind of found because they actually have a very good development plan, lots of capex over there, and we're talking obviously into solar and energy storage. That part I kind of like. I wanted to have something that tells tells me, oh, we're going to invest into solar energy. But then again, I was a little bit disappointed, I'd say, with the capex for next year. The capital expenditure is basically split between maintaining nuclear and coal facilities, and then some growth into the solar. So it's like half and half. They're moving forward, but definitely not as fast as NextEra Energy, or definitely not as fast as Xcel and other stocks that were mentioned in my renewable energy stock video a few weeks ago. So this one, yes, it's interesting, but I would still take it with a grain of salt. The future for Vistra Energy looks very interesting though, and I think this is where it gets to be maybe a good play, where there's some risk and they're still attached to coal, and then if regulators are going like very hard for on environmental issue, it may becomes a problem for Vistra. And keep in mind that they are unregulated business, so when energy goes down and there's like movement in the environment that they're working on, it could lead to financial distress. This is exactly what happened to them back in 2016 when they were part of a larger business and that went bankrupt. So it's still a risk that is around it. But what I like here is the current plan, which is based on debt reduction, and then they want to buy back shares, and they want to increase their dividend to 58 cents per share, and then 76 share per cents the year after in 2022. So if they are able to make that happen, you're going to end up with a company with a leaner balance sheet and more dividend payments, so probably a better yield than what you have right now. So yield over 3% with some dividend growth, a leaner balance sheet, and the move towards renewable energy. This could be very interesting. However, you have to make sure you know the risk that I've highlighted before. Do your own due diligence on this one. It's not a slam dunk. It is interesting, and when you look at the Vistra Vision 2030, you can see that they have some ambitious plans, lots of solar involved, 6,000 megawatts over there. They expect 15% total return for shareholders, mix of dividend payment and stock price appreciation. They also expect a stronger balance sheet, and they want to become investment grade to get better financing. So it's kind of like part of the old plan. If it works, it's going to be amazing, because once they get investment grade, they get like better financing, more appetite for their bonds as well. So it's easier for them to develop their project into renewable energies, and then they can move forward a little bit faster and reward shareholders. At this time, it is the bet that you have to take. It would not be on my buy list just yet. I'm kind of like prefer to wait a little bit, but put it on your watch list. Take a side note and see how it goes. My favorite pick right now is probably Xcel. I would have said NextEra Energy, but NextEra is like super expensive in terms of the fact that they went like their stock price, it just keeps going up all the time. Similar story for America Water Works. For Xcel, better yield, strong growth. That would be my favorite right now for utilities. Now I would like to know, what is your favorite US utilities? Go in the section comments right down below. Let me know what is your favorite. Let's discuss this. Any Vistra shareholders that are pretty happy with the results so far, share that with us at the same time. I'm curious to know more about your favorite utilities. So hope that you have enjoyed this video. Make sure that you like it and you subscribe to my channel to get updates on my upcoming videos. And until the next one, stay invested. Cheers.